Your 30s are when life decides to throw everything at you at once, aren't they? One minute you're celebrating finally having a decent salary, and the next minute you're staring at a mortgage application wondering how anyone actually affords to be an adult. Meanwhile, your bank account is getting pulled in 17 different directions like it's some kind of financial piñata. Kids need college funds, houses need down payments, retirement accounts are screaming for attention, and somehow you're supposed to maintain your sanity through it all. Here's the thing that nobody warns you about when you hit your 30s. Like, everyone talks about your 20s being the time to figure things out, but your 30s, that's when you realize you actually need to have figured things out already. The financial decisions you make during this decade will either set you up for a comfortable future or leave you scrambling to catch up for the next 30 years. My name is Nick, and I help people understand how to build wealth without losing their minds in the process. If you're tired of feeling like your money disappears as fast as you earn it, make sure to hit that subscribe button and give this video a thumbs up if it helps you get your financial act together. Now, before we dive into these milestones, let me be clear about something. I'm not here to make you feel bad about where you currently stand financially. Maybe you're crushing some of these goals already, or maybe you're looking at your bank account balance and wondering if you should just give up and become a professional dog walker. Either way, these milestones aren't meant to be judgment calls on your life choices. They're roadmaps to help you navigate what can honestly be a pretty overwhelming decade. The first major money milestone you need to hit in your 30s is eliminating all consumer debt. And yes, I'm talking about getting to zero. Zilch. Nada. The only exception here is your mortgage, assuming you have one. Everything else needs to go. Credit cards, student loans, car payments, that random loan you took out to buy furniture 3 years ago that you're still paying off, all of it. I know what you're thinking. Nick, that sounds impossible. My student loans alone could fund a small country's GDP. But here's why this matters so much during your 30s. This is your prime earning decade. Your salary is likely higher than it's ever been, and it's probably going to keep climbing. The last thing you want is consumer debt acting like financial quicksand, dragging down every dollar you earn. Think about it this way. If you're paying $400 a month in credit card payments and another $600 for your car loan, that's $1,000 every single month that could be going toward building wealth instead of making other people wealthy. Over a year, that's $12,000. Over a decade, that's $120,000. Not even accounting for what that money could have grown into if you'd invested it instead. Your 30s are also when life starts getting really complicated really fast. Maybe you're dealing with increased responsibilities at work, trying to manage a household, possibly raising kids, and for many people, this is when aging parents start needing more support. Trust me, having consumer debt hanging over your head during all of this is like trying to juggle flaming torches while riding a unicycle. Possible? Maybe. Advisable? Definitely not. I learned this lesson personally when my dad started needing more help around the house. He's one of those stubborn guys who wants to fix everything himself, which usually means I end up either doing it myself or paying someone else to do it properly. Just last week, we had a clogged sink situation where he was determined to tackle it with nothing but willpower and a plunger. Spoiler alert, it didn't work. If I'd been drowning in debt payments, I wouldn't have had the flexibility to just call a plumber and solve the problem. Instead, we'd probably still be dealing with a backed up sink and a very frustrated father. The second milestone is achieving an excellent credit score, and I mean excellent. We're talking 800 or higher. Now, I can already hear some of you saying that credit scores don't matter if you're not planning to borrow money, but here's the reality check. Unless you're planning to pay cash for your house, your credit score is going to determine how much that mortgage costs you. Let me put this in perspective with some actual numbers that might make you rethink how important this really is. Let's say you're buying a $400,000 house, which unfortunately isn't exactly mansion territory in most markets these days. With an excellent credit score, you might qualify for a 6.5% interest rate. Over 30 years, you'll pay roughly $511,000 in interest. Not great, but that's the reality of mortgages. Now, if your credit score is just slightly worse, not terrible, just not excellent, you might be looking at 7% instead. That seemingly tiny 0.5% difference means you'll pay about $558,000 in interest over the life of the loan. That's almost $50,000 more for the exact same house just because your credit score wasn't quite as good. No, but here's where it gets really painful. According to LendingTree, one late payment that's more than 30 days overdue can drop your credit score by as much as 180 points and stay on your credit report for up to 7 years. Imagine going from a 780 credit score to 600 because you forgot to pay your credit card bill 1 month. That one mistake could literally cost you tens of thousands of dollars in additional interest over the life of a mortgage. The good news is that maintaining an excellent credit score isn't rocket science. Pay your bills on time every time. Keep your credit utilization below 30%. Ideally, below 10%. Don't open new credit accounts unless you absolutely need them. And whatever you do, don't close old credit cards unless they have annual fees you can't justify. Your credit history length matters, and closing old accounts can actually hurt your score. The third milestone is putting together a comprehensive financial plan for the next 30 years. I know, planning 30 years ahead sounds about as appealing as a root canal, but hear me out. Your 30s are when you start dealing with multiple financial priorities simultaneously, and without a plan, you're basically playing financial whack-a-mole. I like to use the acronym BRET for this. B is for budgeting and saving. You need to know exactly how much money you need to save and spend to hit your long-term goals. R is for retirement planning, not just contributing to your 401k, but actually understanding whether you're on track and what adjustments you might need to make. E is for estate planning, which I know sounds morbid, but if you have kids or significant assets, it's not optional anymore. The first T is for tax planning, making sure you're using every legal strategy available to keep more of your money. The second T is for, well, I made up this acronym on the spot, so let's call it tracking your progress. This might be the point where hiring a financial planner makes sense, especially if you're dealing with multiple income sources, significant assets, or complex family situations. A good financial planner can help you see the big picture and make sure all the pieces of your financial puzzle actually fit together. The fourth milestone is building a bulletproof emergency fund. In your 20s, the standard advice was 3 to 6 months of expenses. In your 30s, I want you to think bigger. We're talking 6 to 12 months of living expenses, maybe even more, if your income is variable or you're self-employed. Why the increase? Because your 30s come with way more potential emergencies. Your house decides the water heater needs replacing at the worst possible moment. Your kid needs emergency dental work. Your car breaks down, and of course it's something expensive and complicated. Your aging parents need help with unexpected medical bills, or maybe, and this is the good kind of emergency, an incredible investment opportunity comes along that requires quick action. Having a well-stocked emergency fund isn't just about financial security. It's about having options. When you know you can handle whatever life throws at you, you can take calculated risks that might pay off big. You can negotiate from a position of strength at work. You can help family members when they need it. You can sleep better at night knowing that a surprise expense won't derail your entire financial plan. The key is keeping this money somewhere it can earn decent interest but still be easily accessible. High-yield savings accounts are perfect for this. You're not trying to get rich off your emergency fund. You're trying to preserve your wealth and maintain flexibility. The fifth milestone is having 3 times your annual salary saved for retirement by age 40. According to recent data, the average income for a 40-year-old in the United States is around $62,000, which means you should have roughly $186,000 saved for retirement by the time you hit the big 40. Now, before you panic about whether you're on track, let me put this in perspective. If you start with that amount at age 40 and continue contributing consistently, retirement calculators suggest you could have over $2 million by the time you're 67. That's the power of compound interest working in your favor, but only if you give it enough time to work its magic. Here's what's really important. It's about giving compound interest decades by 40 isn't just about the money itself. To understand about this milestone, having a substantial retirement balance to work for you. Every year you delay seriously saving for retirement is a year of potential growth you're giving up forever. If you're behind on this goal, don't despair, but do get serious about catching up. You still have 25 to 30 years until retirement, which is plenty of time for compound interest to work, but the math gets harder every year you wait. Look, if you're spending this entire decade focused on one retirement milestone, you might want to consider increasing your contributions before you turn 40. I'm talking about bumping up that percentage every time you get a raise, every time you switch jobs, every time you get a bonus. The difference between saving 15% of your income versus 10% might seem small now, but over 25 years, it's the difference between having enough money to retire comfortably and having to work until you're 75 because you didn't do the math earlier. The sixth milestone is something I call lifestyle inflation immunity, and this one separates the wealth builders from the wealth pretenders. Your 30s are prime time for what economists call lifestyle creep. You know exactly what I'm talking about. You get a raise, so suddenly you deserve a nicer apartment. Your bonus comes through, so obviously you need a fancier car. Your income goes up, and somehow your expenses magically rise to meet it, leaving you with the same amount left over as when you were making $30,000 less. I have friends in San Francisco making six figures who are somehow always broke. They're driving $70,000 cars, living in apartments that cost more than most people's annual salaries, and eating out every single night because cooking is apparently beneath them. Meanwhile, they're complaining about not being able to save money. It's like watching someone pour water into a bucket with holes in the bottom and wondering why it never fills up. The secret weapon against lifestyle inflation isn't deprivation, it's automation and awareness. Every time your income increases, automatically direct at least half of that increase towards savings and investments before your brain has time to dream up new ways to spend it. Got a $5,000 raise? Great. Automatically increase your retirement contributions by $2,500 annually. So your future self will thank you, and your current self won't even miss money you never had the chance to spend. The seventh milestone might sound morbid, but it's actually one of the most loving things you can do for your family, getting your estate planning sorted out. I know, you're thinking you're way too young to worry about this stuff, but if you have kids, a mortgage, or significant assets, you need basic estate planning documents in place. This isn't about planning for death. It's about planning for life's unexpected curveballs. What happens if you're in an accident and can't make decisions for yourself? Who takes care of your kids if something happens to both you and your spouse? What happens to your house, your retirement accounts, your life insurance? Without proper documentation, these decisions get made by courts and bureaucrats instead of by you. The good news is that basic estate planning isn't nearly as complicated or expensive as most people think. You can get started with simple online tools for basic wills and powers of attorney. Sure, if you have a complicated financial situation or family dynamics that would make a soap opera jealous, you'll want to work with an attorney. But for most people, having something is infinitely better than having nothing. The eighth milestone is one that financial advisors rarely talk about, but might be the most important of all: investing in your health. Now, before you roll your eyes and click away thinking this turned into a fitness channel, hear me out. Your health is your greatest financial asset, and your 30s are when you either build that asset or start watching it depreciate. Think about it mathematically. The average American spends over $300,000 on healthcare during their lifetime. If you can reduce that by even 20% through preventive care, better nutrition, regular exercise, and not doing stupid things like smoking, you've just saved yourself $60,000. That's not counting the income you don't lose due to sick days, the career opportunities you don't miss because you feel terrible, or the quality of life improvements that come from actually feeling good in your own body. It's like, Your 30s are also when your metabolism decides to take an extended vacation. I used to be able to eat pizza for breakfast, lunch, and dinner without gaining an ounce. Now I look at a donut and gain 5 pounds. It's like my body is playing some kind of cruel joke on me. But here's the thing. Developing healthy habits now, while you still have some metabolic flexibility, is way easier than trying to fix decades of damage in your 50s. This doesn't mean you need to become a fitness influencer or start eating nothing but kale and quinoa. It means finding sustainable ways to move your body regularly, eating food that actually nourishes you most of the time, getting enough sleep, and managing stress before it manages you. Trust me, the money you spend on a gym membership, quality food, and maybe a trainer is nothing compared to what you'll spend later trying to fix preventable health problems. The 9th milestone is starting to think seriously about your kids' education, assuming you have or plan to have kids. College costs have increased at twice the rate of inflation for the past 30 years, and there's no sign of that trend slowing down. The average cost of a 4-year degree at a public university is now over $40,000 per year when you include room, board, and other expenses. For private schools, you're looking at closer to $70,000 annually. Now, I'm not saying you need to fully fund your child's entire college education, but starting early gives compound interest time to work in your favor. A 529 education savings plan is specifically designed for this purpose, offering tax advantages that can significantly boost your savings over time. Here's the beautiful thing about 529 plans. The money grows tax-free, and when you use it for qualified education expenses, you don't pay taxes on the withdrawals either. Many states also offer tax deductions for contributions. It's like getting a discount on your kid's education just for planning ahead. Even if you can only save $50 or $100 a month, starting when your child is young means that money has 15 to 18 years to grow. And if your kid ends up not needing all the money for college, you can transfer it to another child, use it for yourself for continuing education, or even roll some of it into a Roth IRA under new rules. The 10th and final milestone for your 30s is developing what I call financial confidence. This isn't about having a specific dollar amount in your accounts. It's about understanding your financial situation well enough to make informed decisions without constantly second-guessing yourself or panicking every time the stock market has a bad day. Financial confidence comes from having systems in place, understanding your numbers, and knowing that you can handle whatever financial challenges come your way. It means you're not lying awake at 3 a.m. wondering if you're saving enough for retirement or if you can afford that vacation you've been planning. This is also when having a comprehensive financial plan becomes crucial, not just helpful. You need to understand how all the pieces of your financial puzzle fit together. Your emergency fund, your retirement savings, your kids' education funds, your insurance coverage, your estate planning documents. All of these elements should work together as part of a cohesive strategy. Some people can create and manage this plan themselves, especially if they enjoy diving deep into financial planning spreadsheets and staying up to date on tax law changes. Others benefit from working with a financial planner who can help coordinate all these moving pieces and provide objective advice when emotions start clouding judgment. The key is having a plan that you understand and believe in, one that adapts as your life circumstances change, and one that gives you confidence that you're making progress toward your long-term goals, even when short-term market volatility makes it feel like you're going backward. Your 30s are essentially your financial prime time. You're earning more than you probably ever have before. You have decades for compound interest to work its magic, but you also have more financial responsibilities and competing priorities than ever before. The decisions you make during this decade will largely determine whether your 50s and 60s are spent worrying about money or enjoying the fruits of your earlier discipline and planning. Your 30s don't have to be a financial disaster movie where you're the star of your own tragedy. These 10 milestones aren't meant to overwhelm you or make you feel like you're behind some imaginary schedule that everyone else seems to be following perfectly. They're meant to give you a roadmap so you can actually enjoy your 40s, 50s, and beyond without constantly worrying about whether you'll be able to afford retirement or if you'll be working until you're 85. The beautiful thing about being in your 30s is that you still have time to course correct if you're behind on some of these goals. Sure, it would have been nice to start earlier, but beating yourself up about past financial decisions is about as productive as trying to drive while looking only in the rearview mirror. It's like so pick one or two of these milestones that resonate most with your current situation and start there. Maybe it's finally tackling that credit card debt, or maybe it's opening that high yield savings account you've been procrastinating on for 6 months. Small, consistent actions compound just like your investments do.